Today's video will be an introduction to Topic 5. In Topic 5, we will be talking about something called posting to a ledger. I told you earlier about the book of a business called a ledger. It's one of the two we'll look at. You've already spent a great deal of time with the journal. Now we'll be talking about that second book called the ledger. On your screen, you see a part of a spreadsheet actually that we have looked at before. Hopefully it looks a little bit familiar to you. We'll come back to that in a moment. But first of all, let's kind of take a time out here and refresh ourselves as to where we are overall in this accounting course. We started out after some introductory things talking about the financial statements, two financial statements of businesses. One is the balance sheet, one is the income statement. We spent quite a bit of time with both. Then we went to the journal, the first book, sometimes called the original book of entry in a business, and you did a number of problems with the journal. And now we're going to be taking a look at the ledger, and we'll use this spreadsheet here as a beginning point. As you know, we are long into the online world and the world of computers and the original books that businesses use for years and years and years have been replaced by automated online software programs. However, the best way to learn about the basics of accounting is to go back to those original books, which were actually books. Page after page of books called journals and ledgers and printed financial statements. So even though businesses now rely on automated methods, we will begin with and have begun with the older methods that still are the best way, I think, of introducing the whole concept of keeping accurate financial records. One of the terms you learned early on was something that was abbreviated by GAAP, General Accepted Accounting Practices. So we're basing all of our work on that. And as I said, it's easier to look at that concept with actual books and actual journals and ledgers. So that's why we're taking that approach. Now, let's take a look at the screen. As I said, you've had this before, and this really gets into kind of a schematic look at the ledger. What you see on the screen are sometimes referred to as T accounts because they kind of look like T's if you look at how they're constructed. But what you're seeing here represents the ledger. There are pages in the ledger book that have different accounts. You see them on the screen here, and we've talked about them quite a bit so far. You will have asset accounts, you will have liability accounts, you will have owner's equity, revenue, and expense accounts. And under each of these categories, under assets, for example, there may well be a number of assets. You may have cash as an asset. Again, this is something that you own, something of value that you own. Cash is an asset. Accounts receivable, which means something that people owe to us. Accounts receivable is an asset. Office furniture, office supplies, delivery truck, all of those types of things are things that we own and are assets. Liabilities are things, as you know, that we owe. The key thing to remember about liabilities is that sometime in the past we gained an asset. So we owe money for that asset. So if you buy office equipment on account, that means you charged it. That means you have a liability. That means you owe somebody money because you gained an asset called office equipment. Sometimes these are called accounts payable. Accounts payable typically mean bills or things that we owe that are of shorter term. For example, 30 days. So within 30 days, we need to make a payment on something, office equipment, for example, office supplies, for example. If it's a longer term, we might have an account called loans payable. That would also be a liability account. We could have mortgage payable. We owe money long term, could be spread out over 15 to 30 years on a building, called mortgage payable. So those are liability accounts. Owner's equity, in other words, this account means that this is the net value, the net worth of the business. We've talked about that in connection with a balance sheet. Revenue accounts, these are things like sales. Any kind of revenue generated by the business is classified as a revenue and is in this category. So typically, if you are a store selling merchandise, you will have sales revenue. If you are a service, we've had, for example, tax preparation services, and those kinds of businesses sell a service. That service that they sell would be the revenue. And expenses. Expenses we determine are things that are the cost of doing business. We do not gain an asset by paying for an expense. Things like electricity, heating, telephone, that kind of thing would be an expense. We need to do it, we have to pay it, but it doesn't generate an asset. This particular spreadsheet with all of these different kind of accounts indicate what you would see in a ledger. And this is a very skeleton version of it. We're going to look at an actual one in the next lesson. But it's important, again, to remember that every account, as you see on the screen here, every account has a debit side, a credit side. Every account has an increase side or a decrease side. And that is going to be different from account to account, from an asset account to a liability account, and so on. So hopefully by now you understand that if an asset increases, that's shown on the debit side of the asset. If a liability increases, if we owe more money, that would be shown on the credit side. If owner's equity increases, that's shown on the credit side. If owner's equity would decrease, for example, the business loses value, it would be shown on the debit side. Revenue accounts typically are shown on the credit side, almost always, but it could happen that we lose revenue. For example, we made a sale, but we had to return something to the customer because it was broken or something. So we end up with a debit. But most of the time, revenue is credited. Most of the time, expenses are debited. If we overpay a telephone bill, for example, that could be a credit, which would decrease the expense. Typically, that account is debited. So again, all of these accounts are found in the ledger. Our next lesson then will show you an actual ledger, and you'll see how it actually does work, how it looks, and it'll be a little bit more defined than this skeleton look. So return at this point back to your course page. Thank you.